Let's put the spotlight then on Anand Rathi. That stock is a buzz in today's trading session, largely on the back of the fact that they have delivered a strong set of numbers. Joining in right now is Anand Rathi himself, the founder and chairman of Anand Rathi Wealth, as well as Feroze Azeez, deputy CEO. Good to have you both on board. Thanks so much for taking time out and joining in. Just want to first, Mr. Rathi, get in your take on the kind of growth that you've seen. 20 to 25%, that's a long-term growth guidance that you would aim for. You're really, of course, on off to a good start with a 32% growth in your AUM, which has exceeded expectations. So will you revisit your guidance?
You see, as you are aware that we have always been little conservative in giving our guidance. And it's always, though our guidance was quite good compared to last year, we have gained growth of more than 25% guidance. And I think we achieved 32% as you've seen. I think this is what we thought we were expecting. And obviously, because achieving this growth was not easy. And therefore, I think keeping in line with our expectations, we have exceeded, of course. And hopefully we'll achieve more than what we have given guidance, but I can't say as of now, because, every quarter, every month could be different in business. But yes, we have a good head start.
Right. Largely also just wanted to understand how much of the AUM growth that you've seen has been supported by the up move seen in the market. Just trying to get a sense of the growth made in terms of flows, new client additions, etc.
Yes, see, when you look at the market move, of course, from the March lows, has been reasonably steep, but it has been followed by a year and a half of time correction. So, in fact, if you look at the last 2 years, Nifty has given sub-median returns. So point is, of course, there is some degree of push, and then we've seen about 32% growth in the AUMs from 32,000 to 43,413 currently. Marginal push over this quarter has come because of market movement. And like in the last quarter, we ended at 39,000 crores. And that was a picture of the 31st March, which is, of course, subdued. But largely, I think the net flows have been very, very healthy. We've been focusing on it over the last year and a half. And that's got some reasonable momentum. And we have tried to build a market agnostic wealth management outfit. So you would see that market performances and the correlation with our performance is not as steep. So in a bad quarter like last quarter, market-wise, it was not such a great quarter, but the results were marginally more than what we had projected. So point is, when you do wealth distribution for HNIs, which is long-term intergenerational wealth, a franchise can definitely be built, which is market agnostic largely. Of course, there will be some correlations. That's point 2. Point 3, new client additions, the pace at which we are adding new clients with more credibility with each passing day with our clients is getting us references. So 55 to 60% of our new client additions, like last quarter, we added about 400 families. 60% of that, 55 to 60% of that comes from client references because experiences of clients over 5, 7, 8 years on risk-adjusted return basis and other objectives which we give as collateral benefit to our clients. When they pan out in actuals, there's credibility built, and that triggers them to refer their friends to us. And I think that will snowball into something big over the years.
The market was rather lackluster as well back in Q4. From then to now, how has sentiment changed on ground?
See, when you look at it, so net flows actually have not declined. Numerically, as optically, they have declined, but we are also doing a drive. This is the period where we try and align our equity mutual fund portfolios to our model portfolio. That needs a lot of money going out and getting realigned to schemes which are newly put in. So from a net flow basis, I think we are just about 100 crores lower, but there's a lot of realignment. We've done one of the biggest realignment exercises over the last quarter, which means that the money could also remain outside during the quarter end because it takes a gestation period for the money to get redeemed from one place to another. Now, coming to your primary question of how sentiments have behaved, especially in an HNI business where there's a one-on-one interaction on a monthly basis, you as a distributor itself influence the sentiment of the client. Our clients have generally had a very market agnostic sentiment. Irrespective of the market, they prepare themselves for a 12-15% correction on a yearly basis, which is what markets have always shown from peak to trough. So their emotions are more or less calibrated to a neutral level at all points in time. So March, they were not so pessimistic. In June, they're not so optimistic. So you have to try and make sure that the people whom you interact on a daily or a monthly basis, at least on a one-on-one meeting, you can influence their emotions to be curtailed so that decisions are more prudent and pragmatic.
Yes, just to add, key thing is that when you're looking for a long-term investment, when you're looking for 3 years, 5 years, 10 years, and that's what, as Feroze said, uh, for long-term investor, I think these changes of 5 to 10% are not very critical. And that's how, as you said, we prepare the mindset of people that we should not worry about these fluctuations uh, and, go to market when markets are bullish or withdraw from the market when markets are good. The question of withdrawal actually comes only if you are a short-term investor. So actually, by and large, our investors remain invested, and we always advise people that timing is not the way to make money in the market. Be invested, be in the right asset class, have the right asset allocation.
Right. The other thing I also wanted to talk about was the fact that in the first quarter, how the flows have shaped up in different segments like equity mutual funds, debt MFs, etc., and which category of investment has actually seen the most interest from investors.
Yes, see, from perspective of from Anand Rathi perspective, for the last 10 years, we've recommended fewer products because we believe that at a point in time, all products can't be good. So we've been recommending structured products, non-principal protected ones, and equity mutual funds and debt mutual funds. This is where the product mix comes from. So we've seen that we don't give specific products. We tell and design portfolios, 4-5 model portfolios. Allocations, as you would see, the product allocation broadly has remained the same. 46% in equity mutual fund has moved to 47%. So that itself implies that the market movement has not just got the AUM up. So point one I'm making is our clients' interest in non-principal protected structure product remains healthy. And because it's derived out of a constituent of one's portfolio. So all these three products, debt mutual funds have taken a dent after the tax change, but they were just about 10% or 12% of our clients' recommended portfolio. Of course, we had 4,000-5,000 crores of assets in debt funds, and those are locked in with the previous tax regime. So that's going to be one of the most sticky monies, but fresh flows in the debt fund category definitely have taken a little beating. And like Rathi ji also said, that we are focusing on long-term wealth creation, and debt has a very small role to play. If the monies are 8-10 years, equities have seldom underperformed debt.
Right, and Mr. Rathi, can you share with us the growth prospects of each of your three verticals? Which one do you think is really going to largely contribute to your growth?
Obviously, the wealth is the key piece, I think even today, the other businesses are not even 5% of the total business. So I think, yes, next 3 to 5 years, obviously, and even going forward, because wealth, again, the amount of people or clients we have got today is minuscule, and the way HNIs are growing in India, the wealth, the private wealth management, the private banking, that's going to be the key growth driver for many years to come. The other business, digital wealth, will definitely support it indirectly. But yes, maybe if you talk after 10 years, maybe that business will grow faster.
Right. Feroze, equity market share is currently at 1% for you. You plan to take that up to 2 to 3% as well. What could be the timeline for the same? And what do you think is going to drive this beyond, of course, the strength in equities?
Of course, we have a market share. We are one of the largest non-bank, non-aggregator distributor, not one of the largest non-aggregator, non-bank distributor. And it's a very fragmented market. As you can see, we are at about 1.18% of market share on the equity mutual fund, active fund side. That will go up on 2-3 counts. One is if the portfolio or the 20,000, approximately 19,985 crores of equity mutual fund, if that schemes chosen are performing well, better than the industry of 380 funds, that gives you a little extra market share. That's a collateral, automated, choice driven. If you're choosing better schemes, they perform well. So your market share goes up relative to the other 380 schemes which are there on the active side. That's point one. Point two, we have been running a very, very evolved mathematical model. And we are not selling individual mutual funds. We sell portfolios of mutual fund rather than products of mutual funds. Now that's finished 10 years and the performance is speaking louder than the words. And that's where several of our clients are consolidating their equity mutual fund assets from other distributors to us using change of broker on the mathematical evidence that they would have been better off looking at our distribution services than elsewhere. So that whole process has catapulted, and I think from a timeline standpoint, we should be able to get to 2-3% in the next few years, 3 to 5 years, and in an ever-growing industry. And you'll be very surprised to know that I was looking at a research report which we generated. Our equity mutual fund assets are lesser than the deposits, the savings account and current account balances in the form of household savings of 670 lakh crores of India. So we are speaking about 2 to 3% market share of industry which is going to explode in the whole decade which we have ahead of us.
Okay, gentlemen, great to have you on the show. That's the management commentary coming in from Anand Rathi. Stocks scaling higher by nearly about 10% right now.